for you. Really now, let's get to the reason why we're here. It's our Economic Power Panel. And you know the gentlemen so well, I'll skip the introductions and spend more time listening to what they have to say about the market. So introducing again, Benjamin Tal from CIBC, Derek Burleton from TD, and Robert Hogue from RBC. A pleasure, gentlemen, to have you again in the sessions. And I think that we should really just jump right into it and get going on it. I'm going to start really around the global economy and what's going on there. And we thought maybe, Benjamin, you could lead us off talking about, what's going on in the global economy and how Canada fits into that. Maybe some headwinds or tailwinds for us. You might be on mute there, Benjamin.
Yeah, the expectations were that the second half of the year will be wonderful, and of course it wasn't as wonderful as expected because of Delta. So we still have this tug of war between the virus and the vaccine, and what was defining this crisis since the beginning, the conflict between lives and livelihood, is still well alive. What I'm suggesting is that everything was postponed. It seems that this is, I believe, the beginning of the end. It is true that Delta is very vicious, but the defense that we have now is much better than we were, a year ago in terms of vaccine, in terms of rapid testing and all this business. You look at India, and although they don't have the vaccine to the same extent that we have, the number of cases is going down, which means that, in my opinion, we are underestimating the natural immunity out there. I think that if you look at the South in the US, you see the same thing. So I think that the herd immunity is better than expected. And therefore, I believe that this is the beginning of the end, quite frankly. And I think that everything was postponed, and we will see a very strong spring, if you wish, where things will go back to semi-normal. And that's something that we have to recognize now. It is true that Delta is tough in terms of the variant. And, the WHO is actually starting to worry what will happen when they run out of the Greek alphabet in order to naming the new variant. So clearly we are expecting more. At the same time, I spoke to some people in the field, and they told me, actually, that's good news that Delta is a tough one. Why? Because for the new variant to actually outdo it, it has to be like a super variant in terms of the infectious rate. So in this sense, this is a good thing. So I believe that if we continue at this trajectory, by the end of the spring of next year, we will be okay. And all the amount of money that will be spent that we were waiting for will be postponed to the beginning of 2022 into the spring. So in this sense, I'm optimistic. Clearly, it depends where you live, and the US is leading Canada, and we can talk about it later. But the issue is that's very important, is that Canada is lagging behind, not only because of the fact that we started from behind, but also for a given level of infection, we are closing the economy much faster. Why? Because our healthcare capacity is much lower than any other OECD country, with the exception of Mexico. Namely, we are basically reaching capacity at levels that other countries will find acceptable. You look at the second wave, and our capacity was actually 3 to 4 times lower than what we have seen in the US, which means that if the situation in the US and the situation in the healthcare is going to determine what we are going to do in terms of policy, you will see the government will have to initiate protective policies faster than any other country, because we reach capacity in the health care system much faster. That's something to think about, and a wake-up call when it comes to investment in healthcare. I will stop here and we can continue later.
Okay, just maybe some comments on, it seems to be a buzzword these days, but the supply chain, the global supply chain, not just for computer components or car components, but the supply chain in general. Does that have a major impact on both the Canadian market and global markets?
Absolutely, but I don't see it as a permanent situation. I refuse to believe that given the complexity of our global system and the global economy, we will find a way to deal with this. So yes, it's going to take longer, and maybe a year from now it will still be an issue, but it's not a permanent situation. It has impact on inflation, but it's going to be short-lived inflation, I believe. Much more important is what beyond this supply chain issue in terms of wage inflation, in terms of shortage of labor. That's more persistent, I believe. I really refuse to believe that the global economy will not find a way to deal with the supply chain issues that we are seeing. This is not a permanent situation by any stretch of the imagination.
Okay, that's great. Derek, why don't we move on to you and sort of give you a really open-ended question here on the housing market across the country. Seem to be active in almost every market. In our HPI Home Price Index models, it's over 90% of the markets across country are in positive territory. And that's almost unheard of in terms of historic numbers. You know, regionally, we seem to do well in some places, maybe not as well in others. But generally, across the country, that kind of national, I guess, increase or positive territory. Just getting your comments on that.
Yeah, I guess we're starting to get used to it, Joel? It seems like we've been in this kind of environment for a while now. We've had a few of these sessions. Yeah, I mean, we're still chasing numbers up in our housing outlook. I even think, even though we keep revising up our numbers, even the latest month means we're probably too low for the very near term. We'll probably see sales come in higher. And I think, you know, you're right. I think you're speaking to the fact this is a very universal, at least, pan-Canadian situation. You get into more of a microscope and you do see some regional differences. The eastern markets are outperforming the west, but I've been amazed at how resilient the west has been. Look at Alberta with some of the worries about the pandemic. They've had a worse fourth wave than others. New Brunswick has had a pretty bad fourth wave, yet its housing market is doing well. I think that's partly a migration story. But yeah, I mean, Canada as an economy is doing quite well. Early worries. We've caught up on vaccinations. We've surpassed. You got a fair amount of fiscal stimulus coming through. You've got a job market that, while Benny's very right, we have lagged on the output side, but our job market has been very strong, and those numbers continue to rise. And we had the Bank of Canada survey expectations out. Employers continue to look at hiring. So I just don't know what's going to slow this market down. Maybe we spend a bit more time in the outlook in a second, but in the very near term, there's little to get in the way of the momentum. Perhaps a limited product, and that also is a pan-Canadian thing. Not a lot of supply out there, but I just see a market where we're still going to be chasing up in the very near term in Canada.
Okay, just maybe your thoughts on the extension of the benefits and maybe that impact on employment, the pandemic benefits and the government consideration of extending those. I think that's past October. Well, coming up. Your thoughts on that?
Yeah. So yeah, this has been again a story. I think there's a very good chance we're waiting to get firm confirmation. It looks like the government's first focus is on the business benefits, the wage subsidy, extending those. They haven't said a lot about the household related benefits yet, but my guess is those end up getting extended as well. I think the federal government has a much better fiscal position than it thought. We're seeing that show up across the country, provinces where revenues are coming in strong. It partly reflects just the fact that we're fairly conservative estimates baked into numbers. It's going to give them more leeway to extend. And, at the same time, you're getting, some debate out there as to whether this is the right time to be extending. Given the improvement in the job market, do we really need extended wage subsidies now? I think part of the thought there is they have been winding them down. So we probably see a continued wind down, but I think it's likely. I think they'll, again, on the business side, it looks almost like a slam dunk. Extend them further. I don't know how long. We'll have to wait and see, maybe a month or two, and then they'll look at them. But the household, whether they'll extend some of the unemployment insurance enhanced benefits, that could very well be likely as well. I mean, this is going to, in the near term, it's going to benefit the economy in terms of spending and the like. Longer term, there's a cost to this. Obviously, we're going to have higher, longer term deficit projection relative to what we had if they just allowed the improvement in the economy to ripple through the bottom line, higher debt and the like. So there's no free lunch.
So true. Robert, maybe just moving on to you, just some of the comments that you made around your September report on the aggregate affordability measure being worse, and maybe the worst it's been in 30 years, and the fourth straight increase. Maybe give us some thoughts on your background on that and where do you think that's going?
Yeah, well, let's start with where we think it's going. And our view is that it's probably not going to get any better, considering how much prices are continuing to rise. And again, it's like as Derek just just said, it's a cross-country phenomenon. Even out in the prairies, where the economy, where we had a lot more concern about the the regional economy, things seems to be picking up reasonably well, especially in the housing market. So with prices continuing to rise and probably outpacing household income, so this will put even more pressure on affordability. Now, what we saw at the start of the pandemic was this big drop in interest rate, and kind of opened that affordability window. Suddenly, a lot of buyers saw an opportunity to buy a home and spend less in terms of their household income to carry that property. And so this obviously was one of the factors that contributed to this boom in the housing market. Now, the prices have gone up because of it, and the lack of supply. And now this affordability window is not it's not only shut, but things are getting worse now. And when you look at across the country, obviously, where affordability is under most pressure, continues to be the same spots are, it's the big urban areas, the Toronto and Vancouver and other parts of BC. We've seen prices rise considerably in Ottawa. We're starting to see some pressures there as well. Similarly in Montreal and Ottawa and Montreal is kind of not quite the same league as Vancouver and Toronto. But really elsewhere, even though affordability is deteriorating, things are not really bad, even like on a relative basis, but also on a historical basis. You look at affordability in Alberta, and Vancouver, and Edmonton, it still looks reasonably attractive. And similarly out east, which is, as Derek mentioned, there's a lot of Canadians now really interested in Atlantic Canada moving. We've seen some movement, the interprovincial migration really shooting up over the first half of this year. And presumably it's Canadians who are seeing some great affordability opportunity to move in. They can buy more home over there relative to say Ontario and BC, for example. So even though in those areas, even though affordability is deteriorating, they're still relatively affordable, and this will, in our view, will continue to attract a lot of people. So it's even though the picture is getting worse, there's still really some wide a variation across the country in terms of what's affordable and what's not.
If I can add something about the demand for workers and the fact that we are facing almost a record high, job vacancy, and maybe to what extent it is because of the fact that there is government support. And I'm starting to think that it's not really a government support issue. It's something more than that. If you look at countries like the US or Israel, Israel stopped support in May, and they're still facing a record high vacancy rate. People are refusing to go back to work. Something is happening here. And if you look at participation rate, it's actually young people and older people, 20 to 25 and 55 plus. The 20 to 25, we can understand. Those are the service sector. Those are restaurants, hospitality. Some of them will come back the minute you stop assistance, but I'm starting to think that not all of them will come back. And then if you are 55 and over and you decided during the pandemic to leave the labor market, you know what? You're not coming back. So I think that the shortage of labor is becoming an issue that will be with us for a while after the supply chain and all kinds of other factors. That's something that will test the Bank of Canada and the Fed in terms of how you fight those inflationary pressures coming from wages, and to what extent you will have the productivity improvement to offset that. That's an open question with major implications for the housing market, because that will determine the speed of increase in interest rates.
And also the immigration picture, right? Because part of the rationale for raising immigration targets is that is because of those labor shortages, and those labor shortages, as you point out, predate COVID. And look at Quebec, for example, that was really struggling with labor shortages in many industries and many kind of the rural parts of the province. And so these pressures are back on like full blown now.
Yeah. Derek, any thoughts on that?
Yeah, I do see it being more of a U.S. story. You know, you look at participation rates in Canada, they've recovered very well. Not saying we don't have issues with labor shortages, but companies consistently complain about that. I think in Canada, it's probably a bigger issue in some of the sectors. Construction is one of them. You know, obviously high contact services. You know, the end of benefits at the margin may help labor supply, but you know, I think the other aspect that's so much more U.S. focused is just the fact the pandemic has got a lot worse. I think there are a lot more fearful older residents in the U.S. that have headed to the sidelines, and I think that's delayed the rebound in the part rates. So Canada, again, we haven't seen quite that same impact. Governments have used lockdowns more than they have in the U.S. to kind of, you know, they're both pros and cons. Short run, it hurt the economy. Longer term, though, you know, it's been a benefit to our labor market in terms of getting people back to work. So, you know, I think for me, the bigger issue right now is the global supply chain issue. And, you know, we speak about COVID. I think that's becoming a secondary risk, albeit the link there is that a lot of parts of the world where supply chains are so important, i.e. Asia, are still battling with COVID, even though if we're past the peak, we seem to be seeing improvements there. But I think that's one thing we're doing is we had assumed 12 months to get through, work through a lot of these global supply chains, taking us into the early part of 2022 for any kind of notable improvement. That, I think, is going to be the story. We're going to be pushing that back to the second half of next year, as others are in surveys are suggesting as well. So it's a real worry. And it's, as Benny said, it's really going to test the Bank of Canada. I think inflation is going to run more persistent. Rate increases, I think forecasters probably are too light on rate increases right now. I think the markets are ahead. They've already embedded 4 rate hikes in the money market through 2022. Forecasters may have 1 or 2 max. So it's going to be interesting to see who's right. Are markets right? Or forecasters right? Or do we meet somewhere in the middle? But I think either way, the rates are going to be more of a test for the housing market going forward.
Okay. Now, we were going to go on to some on the construction industry, but I think this is an area that, in terms of inflation and some of those factors, and as Benjamin had said, maybe some of the supply chain or some of the other inflationary concepts are maybe short-lived, but you know, the future of that, what comes after this theoretically short-lived inflation. Benjamin, maybe you could start us off on your comments around the inflation that we're seeing right now, what that level looks like, and maybe the forward look.
Yeah, I think that of course, we all know that what we are seeing now, like the 5-6%, is a mirage. It's not really inflation because there is a base effect the year over year. We all know the story. So when you pass this anniversary, the numbers will go down. But the question is, to what level? Are they going back to 2%? I don't think so. They will go back to 3.5%. And then the question is how persistent it is. If you look at the contribution of supply chain to inflation, it's significant. Now, it will continue to be significant over the next 6-8 months. Used cars prices is an example of that. I think that the second wave of inflation that will happen in the second half of 2022 will be much more interesting, because that's when you will see all the demand coming. You will see the wage pressure and still lack of supply. And that will be something that, as we mentioned earlier, will be the real test. The market is expecting the Bank of Canada to move like there is no tomorrow. And for some reason, the same market is expecting the Fed to move only once. Go figure. I'm not sure what the market is smoking, but something is mispriced here. It's either the US or Canada or something in between. So that's something that we have to take into account. But I believe that the Fed will move more aggressively than perceived, and the Bank of Canada will move 2 or 3 times. And I think that's the right thing to do. I said the following. Inflation is a lagging indicator. And I'm not talking about this inflation. I'm talking about the second wave of inflation, which is wages and other things. It's a lagging indicator. Do you really want to wait and wait and wait and wait? And then start raising interest rates in a panic like we have seen in any other recession? Buy some insurance. Start raising interest rates a bit earlier to be ahead of that curve. That's basically what I'm saying. And I think that's something that the Bank of Canada is starting to realize. And I think that the Fed will realize soon. The earlier you move, the lower the terminal rate will be. If you move in a panic, you go like that, and you overshoot by definition because you're chasing a lagging indicator. And that's the number one risk facing the housing market at this point. Basically, a monetary policy error.
Okay, that brings up a great point in terms of interest rates. And Robert, maybe you can share some comments on where you think those rates are going. They obviously lead into some of the affordability questions, but that inflation impact and interest rates, we know bond rates and mortgage rates seem to be on the rise now. So
I think roughly speaking, we're on sort of on board this kind of transitory kind of inflation that's out there. I mean, there's obviously some internal debates as far as how long the transition will be. We don't have the inflation rate back to 2% by our current forecast for rising is the end of 2022. We're not there at that point. It's probably going to be a little a story for maybe 2023 or even possibly a little bit longer. But our view still at this point is that the Bank of Canada will stay where it is until the middle of next year, just about there. It will proceed cautiously thereafter. We have, as we speak, two rate hikes baked into our forecast over the second half of next year. So total of 50 basis points by the end of 2022. So in that sense, we don't necessarily see a huge risk for the housing market from a spike. Obviously, if we want to talk alternative scenarios, then this is where there's many other possibilities. But at this point, we feel that the Bank of Canada is, especially some of the comments about some kind of the more kind of inclusive growth, they're going to err on tolerating more inflation than might have been in other cycles, and leaving its overnight rate untouched for the time being, and not overreact to like 3+ or currently 4+ inflation for the reason that Ben mentioned. I mean, there's this base effect, and there's other kind of a transitory phenomenon taking place that the bank will probably won't want to react to dramatically on.
Okay. And Derek, your thoughts on the interest rates, and if you have any on the inflation part there as well.
That is an interesting fact that the Bank of Canada, we're seeing a lot more pricing of rate increases relative to the Fed. I think Canada's been parked in that camp because we're seeing around the world a lot of central banks moving early. And the Bank of England's the latest. They're signaling they're going to be raising rates very soon. And because the Bank of Canada has already started tapering their net asset purchases, winding down quantitative easing, the Fed is just about to make an announcement, but they're lagging. I think that's part of the reason why the market is kind of getting ahead of itself. So I bet, it all comes down to inflation. What I worry about is next year, the persistence, and I worry about a feedback loop. I worry about wages. What do employers do with all these reports of high inflation as they set, year ahead wages? Do they have to make sure they clear the bar so employees don't feel they're getting a real wage cut? And so, the wage side, I think, is huge. And I worry about, as mentioned, I think the supply chain side. Every day I'm reading more reports. Now, concerns in the auto sector aren't just semiconductors, they're aluminum, they're magnesium shortages. It just seems like it's whack-a-mole when it comes to the supply chain. And, this is what's delaying any kind of notable improvement. I think we're counting on the big shift from goods-related spending to services as economies reopen to kind of quell some of that. But then at the same time, it's going to put more heat on the labor market to ensure we got enough employees, because the service side model is so employee driven. So like the others on the panel, Benny and Robert, I buy into the temporary story. I don't know what you have to. I mean, it's very uncertain, and we've seen inflation come in low for so long. But I just think there's a huge range of uncertainty around baseline forecasts for next year.
Yeah, I think it's important. I think it's important to realize that inflation at the end of the day is not the issue, because the Bank of Canada and the Fed have the ammunition to deal with it, the weapon to deal with it. It's how quickly they will raise interest rates to lower inflation. And to me, that's the risk. It's not really inflation going to 10%. That's not going to happen. It's basically how the what will be the reaction function of the Bank of Canada and the Fed to that inflation, and how quickly they will take it down, and what will be the cost of the economy in general and the housing market in particular. I think that's the key question. Yeah.
It is key, but the thing is that it can create quite a disruption in the near term if they get behind the curve. The world, Canada, it's all oriented towards rates remaining low. We've had such low rates for so long. If there's any kind of hiccup, yields come in higher than expected. Markets, financial market conditions have been very attractive, favorable. That's a key cog in any kind of economic forecast. So that's what I worry about. I worry about the disruption to go from A to B, but good point.
Yeah, I was going to ask what keeps you guys up at night, but I think you just shared all of that with us. So why don't we move on to the maybe getting back to some of the housing market and look at the new construction market. I know some new stats came out today in terms of the direction that was going in. Benjamin, do you have any thoughts on that new construction piece?
Yes, whatever we build, it's not enough. That's my view. And I think it's something that we have to realize, and that's something that people really don't get. And we talk about supply a lot. I think that we are underbuilding 20, 30,000 units a year on average. And I think we have to build much more, and we have to build differently. And that's the key issue. You know, just let me share something with you. Exactly a decade ago, I was asked to participate in a debate in New York. It's an IMF-sponsored symposium. And it was closed doors, about 30 people, the biggest fund managers globally. Mr. Greenspan was there, Myron Schultz, the Nobel Prize winner in economics, was there. And the topic of this debate was short Canada, 10 years ago. Why? Because of the bubbly housing market in Canada. And I was debating a hedge fund manager from New York. It was the easiest debate of my life because the guy didn't know anything about Canada. But the point that I'm making is that since then, house prices went up by 85%. So much for a bubble. Back then, it's fundamental misunderstanding of the issue that we are facing, and that's lack of supply. And that will continue to be the case, regardless how much we build at this point, because we are not building enough, we are not releasing enough. And I think that on a fundamental basis, we are underestimating big time household formation growth in Canada. When we measure population growth, we are misrepresenting growth in household formation because we miscount non-permanent residents and many other reasons that I won't get into. So I believe that whatever the official numbers are telling you, it actually works in terms of supply-demand mismatch. That's something that will continue to be the case. And again, the fact that people believe that 10 years ago we were in a bubble tells you that there is misunderstanding of the issue, and that will continue to be the case. So I believe that whatever we see now, it's probably not enough, and we probably will need to see much faster rate of construction. That's one thing. The other is to what extent there will be another source of supply of older people leaving their house or actually simply dying, and to what extent this cohort will be a source of new supply. I think it will be, but it will not be sufficient to actually fix the mismatch that we see in the market.
Okay. Robert, why don't we bring you into this conversation, talk about, and maybe any thoughts on new construction, but as well, maybe the rental markets as well.
Yeah, well, I mean, in terms of construction, I totally get Benny's point that we need to build more. And this is not to imply that there hasn't not been a supply response. When you look at over the last 12 months, housing starts have been extremely strong. And I think to kind of eventually one day sort of have enough units out there, those kind of levels will have to be sustained for a period of time because it's a bit of a moving target from a household formation perspective, but what more broadly from a population growth perspective, because Canada is about to increase its immigration targets quite significantly, and we're going to see population growth not only pop up, but potentially, at least in level terms or in terms of number of people, reach some record levels. So those people will have to be housed. we need to build more. And my concern there is not just having the starts there, but it's to get from starts to completions. And this is where you get into capacity issues. We know that the type of housing that we're building now are more complex, that's much more into multiples. Those big condo projects, for example, take a long time to complete. So it's great to see this big builder response, but those units will not be available to move in anytime soon. So we have to keep that in mind, and hopefully kind of I'll say policymakers at large, but probably more municipalities, think they would need to think a bit more about the speed of construction of the units that they tend to that they approve or they put into their development plans, because we need those units now a lot quicker. Now, on the rental side, it really is. Now we've seen, and I think we've talked about it in past events. We've seen sort of let's say a bit of a resurgence. We have a bit more interest in more construction of purpose-built rental units. But really, again, to repeat what Benny has said, it's just not enough. But also, it's not spread across the country that equally. A lot of the response that we've seen is in Montreal and Toronto, for example, which has a very strong demand for rental. And we expect to see even stronger in the period ahead. There, it's still a fraction of what it should be. And so I think there's a lot more efforts that will have to be done on that front. Again, it could be finding ways to even the playing field between purpose-built and condo projects, or it could be even just like outright incentivizing more, because I really do think that our housing stock needs a lot more rental units in there.
Okay. Derek, why don't we bring you into that conversation in terms of, or maybe try and get your comments around the whole immigration, the increase of immigration, not there right now, but coming, already a lot of demand for a limited supply of housing versus employee or employment levels. How do you match all those pieces together?
Not easy. Yeah, so I mean, that is sort of a longer term story that is beginning to come back again after the pandemic. The immigration from internationally dried up and now is beginning to rebound. I think as we get into 2022, it's going to be more of a normal year for population growth, driven in large part by the rebound in interprovincial migration. Not where we were, kind of high horse peak, and I think it was 2018 was our peak, 2017, but getting back to kind of that, above 1% population growth. So that's waiting for us. And to Benny and Robert's comments, this is going to put a lot of strain longer term on the housing stock and the need to speed. I think in the near term, it is an economic recovery story. It's a return to office story. The condo segment has really picked up. It was a very imbalanced market for a while, everybody chasing to the greener pastures of the suburbs and outside of downtowns. People are beginning to flow back. Very good news for condo investors, no doubt. And that's going to be the next leg. I don't see what's going to stop that. The return to office plans have been delayed, but they haven't been derailed. I think it's going to happen, especially with the virus doing quite well. I mean, there's still risks around the fourth wave and the Delta, but so far so good. So I'm optimistic about employment and return to office next year. So I can see the real pendulum swing back towards downtown markets in general. We're not going to get fully back to where we were, but enough of an impetus that it's going to really tighten up those markets.
Yeah, I agree on that, because I think that all this business of the Toronto refugees, the Vancouver refugees was exaggerated. Yes, a lot of people moved away from the city, but if you look at the overall share of people doing it, it's like 5% of sales. It's not really a big story, quite frankly. It was a big story for the people who moved, but it's not a macro story. And you know what, when you have COVID, the city has nothing to offer. Yeah, everything is shut down. So the premium of living in the city is basically zero. The minute you open up, people realize that Toronto is a nice place, Vancouver is a nice place, Montreal is a nice place, they move back. again, I agree that it's possible that many companies will say, we want you 2 or 3 days in the office. So what are you going to do? Maybe rent an apartment if you moved away. It's going to be back, I believe. And we're starting to see it. The condo space is back. You look at this gap between pre-construction and resale prices, it's basically back to 10%. It used to be 20%. So something is happening. It's warming up, reflecting the increased premium of living in the city.
Okay, that's tremendous. Why don't we shift over to that really impactful election that we just had, which changed so much about the makeup of our government. But really, there was an awful lot of issues on the platforms around housing, the economy, and so on. How do you think that's going to impact sort of everyday Canadians? And maybe we'll start with Derek on this one.
Yeah, housing was certainly well up on the list of priorities in this campaign. Both commitments to increase supply, and so a lot of promises as well on the demand side. The Liberals one, as you mentioned, Joel, very much a status quo, but I think a lot of the Liberal housing platform will get implemented. There's a lot of cross currents there because, of course, on the demand side, there were some areas that will weaken demand, banning foreign investment for 2 years, assuming they get that in there. Taxation, if you sell within a year, that's negative for demand, but they've done enough in terms of helping younger buyers, primarily improve affordability through new savings accounts. We think net it's probably not a huge boost to demand relative to the status quo, but some boost. The thing is that supply will be lagged. Notice the funding in their platform builds us in starting next year. So it's not like overnight they plan to do everything, but in terms of I think it's 100,000 in units they've committed to increasing through, I think it's a new fund. That's going to take long time to kind of roll out in my view. So net, it's probably going to worsen the affordability, albeit not hugely, but you add even a small amount of demand on a market that's drum tight, and it's probably going to lead to a further erosion of affordability. We haven't built that into our forecast. We'll wait till it gets implemented, but that's an upside risk, I think, to the kind of the near term housing outlook.
Okay. Robert, maybe get your comments on some of the structures around the foreign buyer programs or restricting foreign buyers, the capital gains on principal residence, your comments around that and what kind of impact those may have.
Yeah, I think as far as the tax on foreign buyers, I think that's coming on 1st of January 2022. We're still waiting for all the details of it, but my understanding is that they will model it to what the BC is doing. Basically, it's requesting people to fill up some kind of forms to attest that their units is empty or occupied, and so our view is not that it's not a game changer. Where we don't expect that to do much for the market, and I think those probably where foreign owners or foreign investors are most present, and I'm thinking more especially in BC, there's already some taxes there. I mean, it's already been sort of addressed. So really, what it's and the marginal effect would be on other markets, possibly in the GTA, where foreign buyers are investors are more involved in. So it's unclear to us that that's going to move the needle that much. It might be a little bit of new stream of revenues, and maybe for us, and may give us a bit more data to look at to give us a sense of the makeup of the owners out there in Canada. And that being said, just a little bit of an aside here, I think I have to mention that StatsCan is doing some great progress on its housing statistics program. So we're getting more kind of a more color on the housing market and the housing stock, except it's just not a broad coverage. I just thought I'd mention it because that's something like the data gap has been something that we've been talking about for a good decade at least, that there's some finding some progress on this. And what was your other
On the
change?
capital gains tax.
Oh yes, capital gains. Yeah, it's essentially it's a tax on flippers. My understanding, again, there was not much detail in Liberals' platform, but my understanding, if an owner resells within a year, then they would get a tax, and there would be some deductions for any kind of improvement made on the home, and there would be some exceptions if people have to sell for medical reasons or whatever. So it's one measure that we've kind of speculated for many years now. What can the government do to cool the market? And it's one of those that it's not a clear-cut winner necessarily. I think there might be some rationale for it, but there are some pros and cons. Really, I'm not entirely convinced that flippers are necessarily a clear-cut negative, because they do improve the housing stock, for example, and also just in terms of implementation. I think it's probably likely to be quite complex.
If I can add a few things here, one is regarding the supply issue. I think that what the government clearly is doing is basically helping demand in the near term without actually attacking supply, and therefore the situation will get worse. And I totally agree with Derek on that. I think that's something that we have to take into account, and that's extremely important. We have a situation in which the government is so wishy-washy on the supply issues, and they're talking about 100,000 new units. Good luck with that. Find workers for that. We will have really supply issues just to get that supply, and that's something that I'm talking about. But there is another point that I wanted to make, and that's relevant to Toronto, and that's a new initiative coming from the city of Toronto, not the government, and that's inclusionary zoning. Inclusionary zoning is happening in Toronto. It's already in Vancouver, as we all know. Happening in Toronto, it will start soon. And basically what we are going to see, it's preliminary, but what we're going to see is about 5% of units of new condo will have to be affordable, namely below market rate. And if you get some goodies, you can actually go to 10% inclusionary zoning. That's significant. Clearly, some developers are not so crazy about it. In Vancouver, they are working with unions and other groups, so you get basically the same type of people into the building. Toronto, that will not be the case. It will be random. The city will vet and basically interview the renters, but the developer will be the landlord. And again, we're talking about 5 to 10%. That's not insignificant. And what we are hearing from landlords, this will actually lead to higher prices for the remaining of the condo residents. So that's something that we have to take into account. It's happening. It's a given. It's just a question of when it will be implemented.
Taking that a little bit further, Benjamin, maybe your thoughts on the first-time homebuyer programs and maybe the expansion of those by CMHC or other players out there in the market?
Yes, I don't think it was a game changer by any stretch of the imagination. I don't think it was a big success. The participation in the equity was not a big success. People don't want to share their equity with the government. So I will not really count on this to really make a big difference, quite frankly. So I'm encouraged by the fact that we are talking about supply for the first time. And that's a good thing. I just say it will take much longer than perceived.
Okay.
But Ben brought a really good point here. I think more on, if we're talking supply, I think it's more at the local level that they're going to see a lot more potential impact on the market. I don't have a great hopes that the federal government, and in fact that's almost by structure, federal government, it's too far removed on that from a jurisdiction's point of view to have a clear effect other than just sending money, like their accelerator fund. I think Derek has mentioned it, which I think is a very interesting initiative and a really interesting proposal. But I think that's probably as much as what the federal government can do from a supply point of view, to make an impact on the market. I think there's going to be some provincial elections in Ontario and Quebec next year, I think we're going to hear more about housing supply and housing issues. And I think they're probably that sort of level of jurisdictions that may have a bit more an impact, potential impact on the market than the federal government.
Okay, what about potential increases for mortgage insurers to go past $1 million? Now that the average value is so much higher, you take out markets that Toronto and Vancouver from insured type products. Do you see that as a possibility?
I think that's, if I may, I think that's the most significant move by the government, quite frankly, and I think that's something that will help a lot in terms of affordability. But another thing that is going to help, and that's something that we have to discuss, quite frankly, is gifting. Gifting is going to be the most important issue that is not a policy issue. And it's actually probably stronger than any policy issue combined, all policy issues combined. We estimate, and that's very important, that it's not a marginal issue anymore. Gifting towards down payment is a major macro issue at this point, impacting the housing market. We estimate that about 20% of first-time homebuyers are receiving gifts from their parents mostly. The average gift is $150K for first-time homebuyers. Another 6-7% of mover-uppers, not first-time homebuyers, get a gift, and this gift is about $200,000. You do the math, it's about $30 billion a year of gifting. That's significant. Those numbers are in the sky, and we have seen a huge increase of about 40% in that gifting during the pandemic. So I suggest that until now, we were talking about gifting as a marginal issue. It's becoming a major issue determining the mathematics of home ownership with major impact, I believe, on affordability and demand and therefore price. And that's why I think that we have to pay closer attention to this, because it's really not just something at the margin. Very important to understand the numbers are rising very, very quickly. And some of those parents simply have the money because of the cash accumulated in their checking account during the pandemic. So that's important to understand.
Yeah. Okay, why don't we're getting close to the end here, but I did want to give you some time individually to talk about maybe what you're telling your CEO internally for each of your banks, what you think both the risks and possibilities are in the market. And maybe we'll start with Derek on that one.
Oh, what am I telling the CEO of TD Bank Group? Yeah, no, it's a good question. I think, it comes back to the point that I just don't know what's going to slow down the market in the very near term. We've been chasing the numbers up. We do that for a reason. We look at from a longer term perspective, thinking, we've overstretched on affordability measures. If there's one direction the market can go. And I still have some concerns longer term that, we may be overshot to some extent. But in the near term, it's going to be strength to strength. And even the higher bond yields, we're seeing more clients take advantage of variable interest rate mortgages. Those are still very low rate. And that's going to kind of shield, I think, some of the near-term impact as yields continue to head up in the coming months. So, and then you get into next year, I've kind of given the view there, you got migration picking up. So, yeah, I mean, the risks would be, any kind of major negative financial event that hits Canada. And, we would see some significant unwinding of the recent strength. That's just the way it is. I just don't know what would be behind it. And that's not something. So that's the standard risk we've been saying for years, is that, some anticipated negative financial shock, big market meltdown. Of course, there'd be impacts in housing. But the upside risk, I think, of anything, my forecast would be more tilted to the upside in the near term.
Excellent. And Robert?
Yeah, I mean, starting point, right? If we're talking, okay, let's look forward over the next year or two. The starting point is so incredibly strong. I mean, from a demand perspective, from a lack of supply, and therefore, demand supply conditions extremely tight. So it's hard to imagine some kind of meltdown on like in terms of property values or prices. That you may see activity slow down. It could, as we've seen over the last several months, but including in September, it's as much, if not more, of a supply story than a demand story. Supply is not there. Transactions are not taking place. I'm sure you're seeing it at RPS. So still, and you look at the demand fundamentals, we've talked about interest rates. I mean, this is probably a second half of 2022 kind of story where we might see a little bit of a upward pressure. And in terms of immigration, demographics still pretty strong, and an economy that's continuing to recover. So incomes are going to continue to rise, probably not in the kind of support that we've seen through the pandemic through transfers. So all this, to me, argue for is still a pretty strong housing market from a historical perspective. Probably not as strong as 2021 will be overall, because the starting point, the early part of the year was so incredibly strong. But I think what we might see, though, is some more kind of diversity in outcomes. What we saw through the pandemic is all markets are going all in the same direction, all strong, and it's hard to tell the differentiated story, which is usually what housing is, discussing about housing is all about, is different markets having different work on, had their own kind of idiosyncrasies. But in this, through the pandemic, they're all in kind of going through exactly the same thing. And I think going forward, we might see a bit more kind of a diverse set of outcomes. Probably some of the smaller markets have gone a little too far. We might see some corrections there, for example, and others that will continue to be very, very strong.
Okay. And Benjamin?
Yes, 2 points. First of all, I will tell them to watch for inflation, of course, and the risk of higher interest rates, because the number one enemy of the housing market is not rising interest rates, it's rapidly rising interest rates. So we have to look at the response function from the Bank of Canada and the Fed, and to what extent they're behind the curve. That's number one, and that's a risk that we are facing. More important, I think, from a long-term perspective, is that if we have this huge lack of supply, what is the response to that? You cannot just build, because we simply can't. The response is innovation in real estate. Now, you look at innovation, patents, real estate versus any other industry. Real estate is like zero. All the rest are up. We are still building the way we built 200 years ago. It's like we haven't changed much. However, you look closely, startups in this field, in this space, starting to rise and grow in a very significant way. And I say invest in this domain, because that will be the new wave of innovation. Because when you're desperate, you innovate. And to me, that's a major source of opportunity. Innovation in real estate, and it's starting already. The way you build, how you build, the material you use, and it's coming. And I see many small companies starting, needing capital, and I see a major investment opportunity.
Good. Well, that was going to be one of my closing questions, is where are you going to put your money in terms of the housing market?
So you got my answer.
Yeah, there you go. So maybe Robert, where would you be putting your money now?
Again, the theme that we talked about a little earlier, I'm very bullish on rental market. And you look in the years to come, from an affordability point of view, people are going to be shut out of the housing market, especially, the day in interest rate will start rising. But also from a demographic, from immigration, we know that immigrants typically rent the first few years they live in Canada. So I'm pretty bullish on the prospects for the rental market.
Okay. And Derek?
I'm going to say Alberta. I think you buy low. And I know Alberta's facing some transitional questions, big ones. The high oil prices, high nat gas prices right now are certainly help soothe some of those worries this year, but that still remains where we head. But I'm an optimist. I do think Alberta's going to figure all this out, and I think it's going to come out quite resilient. And prices are, more attractive there right now. So I'll go out on a limb and say Alberta. I do feel that way.
All right, we have just a couple of questions from the audience, one of which was around the Bank of Canada. And certainly some of the levers they have to pull are higher interest rates, moving that up. But what are some of the other things that they could do to deal with both housing prices or inflation and those factors?
Well, the short answer is nothing. They focus on interest rates. So yes, they're going to end QE. They will end up with $1 million a week, which is neutral. the next move is higher interest rates. And that's basically it. They cannot do anything else. The only thing you can do is not to make a mistake and wait and wait and wait and then start raising interest rates in a panic. So don't make a mistake and we will be fine.
Yeah, they can't allow their balance sheet to run down. I don't think anybody's building that. And you're right, Benny's right. I mean, interest rates are their primary tool, but they can drain some of this liquidity out of the banking system through running down its balance sheet longer run. It's sort of the inverse QE. It's one tool they still have.
Okay, well, we're pretty much at the end of the hour. I just wanted to open up for any last comments that you guys may have, something that we haven't covered that you think is important that we haven't created a question for yet. Maybe we'll just start with Robert quickly. Is there anything that we haven't covered?
It was just like going through my mind quickly because there was a point earlier that I thought, oh, I should make that point, and now it escapes me because you put me on the spot first here.
Sorry.
No, just to reiterate the point that I think looking back the last 18 months, how incredible the market has been. Well, we think there's still more and more in the tank. Yeah, there's lots of risks out there, but I think if there's anything that we've learned is that do not underestimate the housing market and people's desire to own a property. They're willing to spend a lot of money and make a lot of sacrifices to own a property.
Definitely. And Benjamin, any last thoughts?
Yeah, I think that the most important issue is really the move from owning a house to renting a house. I believe that the future of real estate in Canada and in the big cities is really rental as opposed to owning a house. I think that the propensity to rent will be much higher 10 years from now, just because of affordability, and that will be a good thing. I think rent should be part of the solution, and I'm totally with the other panelists suggesting that we need more purpose-built, and we have to encourage that kind of activity.
Okay. Last thoughts, Derek?
I'm just trying to think of any last thoughts. I think hearing a lot about stagflation. I know we didn't touch on it today in the panel. We're more focused on inflation. That's one of the big market risks at the moment. And let's recoin that. Let's call it slowflation. The stagflation of the 70s. I think Benny pointed to that. We're not going to see 10% inflation, 10% unemployment rate. That was a very different era. So slowflation would be a risk, but I'm still optimistic on the likely outcome for the economy.
Excellent. Well, that really brings a close to the time that we've got today. I want to thank the whole panelists and all of our audience for participating today. Very insightful, and the back and forth comments was deeply appreciated. So thank you for everyone. We appreciate your time. We will be doing that recording and sending that out. We do have a quick survey at the end of the session here for you to log in and do that. And we certainly hope that your family stays safe, that the business reopening goes smoothly, that we get to that sooner rather than later. I think that's good for everyone involved. So again, have a great day, and we will talk to you again soon. Bye now.